Volume is the second foundation of technical analysis after price action. Overall, it's also a straightforward concept, but it's not always fully understood because of its slightly more abstract concepts when compared to the straightforward premise of directional price action. Before further elaborating on the definition where volume is the quantity of a security traded within a given period of time, there's a quick note to take into account. That is, it's generally easier to analyze a volume in markets that readily and accurately publish a volume, which generally means the stock market and cryptocurrency market are more suitable. Other markets, such as commodity futures and forex, are not as reliable in terms of the seamless reporting of a volume made available to the public. In fact, in most cases, most all charting platforms won't display volume for such markets. The amount of stock shares and amount of cryptocurrency traded is easily and readily tracked. The trading volume for other markets is comparatively more difficult to track. For example, Forex is more difficult to track as it is traded all over the world. That also involves cash exchanges and exchange of currency in less transparent parts of the world. By contrast, stock markets around the world have more clearly defined operating hours and geographic regions, making every share being bought and sold very easy to track. Cryptocurrencies have less defined operating hours and geographic regions. Essentially, it is like Forex, where currency is being traded all over the world at all times. However, the technology around blockchain and digital ledgers makes it as easy, if not more easy, to update trading volume similar to stock markets. With this in mind, it's not to say stocks or cryptocurrencies are superior for analysis. In later examples, there will be cases where charts without volume can be analyzed adequately without volume. Volume simply refers to the quantity of a particular security being traded during a particular time. So often, when volume is green, it means price increased, and when it is red on most all platforms, that means it is a decrease in price. It could be said 5 million shares of a stock were traded during a 1-day period, and that resulted in a price increase. Or, during another day, there could have been 2 million shares of stock traded, and the overall result was a decrease in price. The following series of diagrams will revolve around this drawing, which is, as you might guess, is the sun. The sun, as you may already know, is just one of many stars in the universe. For our purposes, the sun can be likened to one chart or asset within the universe of financial markets. For our example, the sun will be a stock within our galaxy, the stock market. Other galaxies can be thought of as other markets, and the stars within those galaxies can be thought of as charts within those markets, such as charts within the Forex, commodity futures, or cryptocurrency markets. You may also know the sun has lots of energy that sometimes gets concentrated in the form of sunspots. Don't worry, this won't turn into an astronomy lesson, it's just a helpful analogy to understand volume better. Now think of the sunspots as representing the total amount of shares for a stock. So in this example, there are 13 spots. Let's say each spot represents 1 million shares, giving us a total of 13 million shares for our hypothetical stock. That means in total, there are 13 million shares that exist for this stock. The circle in the middle represents outstanding shares of stock. These are shares not owned by the company that issued the stock, because the shares are out and trading in the market. The spots in the triangles represent shares of stock still held by the company that issued the stock, and or they can be shares of stock held by traders and investors. That can be individuals or institutions that bought the stock. In the cryptocurrency market, the circle in the middle represents the cryptocurrency that has already been mined and is currently being traded on the market. And the spots in the triangles would represent cryptocurrency that has yet to be mined, or currency that is currently being held by traders and investors that once again can be individuals or institutions. The same idea applies to other markets like commodity futures and forex. The circle in the middle represents what is currently available in the market to be bought and sold, while the triangles represent the portion of a security that is not currently available to be bought and sold. Just like energy moving in the sun, shares of stock are constantly being bought and sold, and that results in movement of price up and down. A volume relates to the magnitude of price movement. For instance, when there is a large decrease in price, there will often be a large red volume bar to show more selling than buying took place during a particular time. And sometimes it can be difficult to understand charts that show a larger movement in price without necessarily exceedingly high levels of volume. Here, there are 1 million shares of stock being bought, hence the green dot, and 0 shares being sold. Obviously, this would virtually never occur in the stock market. In this case, it's just to demonstrate what happens when there is more buying than selling in the market. In this case, there is a surplus of 1 million shares being bought, and that is enough to increase price. There is no exact ratio or quantity of shares that needs to be bought. As long as there are more shares being bought than sold in a given period of time, price will increase. Naturally, price will move more drastically if there is a more drastic imbalance between buyers and sellers. In this case, a more drastic quantity of buying leads to an increase in price that is quite sharp. The reverse would also be true. If there were drastically more sellers than buyers, there would be a drastic drop in price. These basic concepts are generally true on all charts, but there will be a variation depending on the market conditions, and the particular security being examined. Another rule of thumb to keep in mind is generally the more liquid a stock is, the larger imbalance of buyers and sellers will need to take place in order to significantly move price. A chart with high volume is said to be liquid, while a chart with low volume is not. Normally, high volume can be considered when it's at least in the millions of shares being traded. So, for example, if the stock of a large liquid company was to be traded and price was to increase significantly, there would need to be a drastic imbalance with lots more buyers than sellers. That would be in contrast to the lower volume needed to move the stock of a small company that has less liquid trading volume. Though the trade-off is less liquid stocks have wider bid-ask spreads because there are less buyers and sellers to agree on trading prices. In contrast, highly liquid stocks will have thin bid-ask spreads since there are lots of buyers and sellers to offer varieties in trading prices. Price is moving up for this stock because there is a bullish imbalance, more buyers than sellers. The greater the imbalance, the more drastic the price movement. In this case, now there are 2 million more shares that are bought and none being sold. Then step it up a notch to an extreme imbalance of buyers to sellers, resulting in a near vertical climb. Such a scenario can occur when the market responds positively to a company's earnings report. Now, with 1 million shares being sold, the imbalance is back to when there were 2 million shares that were bought and none being sold, and that results in a shallower incline. Also, now there are only 1 million shares available to be traded in the market, and 8 million shares are still held in positions either by traders and investors or the company that issued the shares. In any case, there are 8 million shares that have the potential to enter the market for trading in the future. Next, 3 million shares leave their holdings and are available for trading in the market. It doesn't matter if they were shares held by the company that issued the stock or by traders and investors. The end result is there are now 3 million shares available for trading, in addition to the 1 million shares that remained, making for a total of 4 million shares that can now be bought and sold in the market. When 1 million more shares are sold, stock price decreases, but it is still up overall for this particular trading session. The incline is much lower now. It more closely resembles the earlier situation when there was a surplus of 1 million more shares being bought. When there are 3 million shares both on the buy and sell side, price remains flat and virtually unchanged. In real live markets, there would virtually never be a situation where there is equal buying and selling. However, it is quite common for this to almost occur, where there is near equal buying and selling, resulting in relatively flat and unchanged price. Now begins a conceptual demonstration of a reversal, in this case a downswing, when there will begin to be a greater amount of selling than buying. As would be expected, a decline begins. Then, buyers that bought earlier in the session begin to sell, and that results in the market tipping down even more. This is the exact opposite of what was seen earlier, as the market begins to rebalance and go into a rapid decline. Then the market suddenly moves back with more buyers than sellers into an incline to finish the trading session. Such rapid fluctuations are common during periods of volatility, especially during periods of uncertainty and decline. These characteristics can also be seen during highly speculative periods, such as when a new stock or currency begins trading on the market, or what is commonly seen with biotech stocks. Similar to price action, there are many synonyms describing volume, such as energy, force, pressure, interest, or potential. It's essentially the market consensus behind the price action. If the consensus is more bullish, there is bullish volume, therefore more buyers than sellers, and more likely to result in a drastic increase of price. And vice versa when talking about bearish volume and price action that has a large decrease in price.